Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of proprietary options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we'll discuss 3 of our proprietary theoretical values that are designed to help you find the best options trade meeting your investment objectives. These theoretical values are distribution edge, forecast edge, and smoothed edge. We'll also go over the trade from last week, which was a short put spread on IWM. Matt, if you're ready, do you want to share your screen and get us started?
Yeah, thanks. This is a big topic. I used to be a market maker on the SIBO floor and backed a bunch of people, so we would use theoretical values a lot. I think they're underutilized for most traders out there, so it's an exciting topic that we're getting into. Yeah, so the trade that we put on last week was selling a put spread in IWM, and it immediately was profitable, 60 cents from $1.70, and then the market corrected and went down to $2.60, so it was down $1, and now it's kind of flattening out. We're short the 197.5, and stock's now 202. So in a decent position for the IWM. If we go to our positions page, again, you could see the IWM, a lot of green over on the right-hand side. So clearly we want it to go up since we're short a put spread. And so that's the trade that we put on last week. You could also check our new journal out. It's not totally done yet, but there's the trade that we put on right there. $1.70. We're down like $30 on it right now. You can see that as well here. It's trading about 198. We also had an open short put spread in EWJ. We had a short iron condor. So let's look at that. Again, with the trade journal, we'll unclick that and go over to the trade journal, EWJ. So the iron condors, we were short the 69 calls and 65 puts in March. On March, the expiration, we were assigned, but we immediately sold the 69. So we essentially lost 57 cents on that call, but we sold it for 77 cents. So we were up 27 cents. See that okay, Tyler?
Yep.
And the short put spread, we're down 60. So we're about a break even on that. So we're kind of fighting our way. We're a little bit up, but we're fighting our way with the EWJ. So we're looking decent on both of those trades.
Great.
Yeah. So let's start talking about theoretical values, and I think it helps to have a strategy that we could look at, especially one with a lot of legs. So there are 3 types of theoretical values that ORATS has, and we could sort on those and put those in our scanners. But the D stands for distribution, the F stands for forecast, and the S stands for smoothing. Now,
so just to confirm, Matt, so a theoretical value, what we mean by that is it's our what we find to be the value of, like, the price of the trade. So the theoretical price. So we're just looking at the trade price.
It's a way to get a value for an option. It's not the way, and you never should just trust it implicitly. But I think if you start seeing a lot of edge from each of these, you could be more confident in the trade. There's a lot of other things that go into the research of a particular trade, but when it comes, like back testing, looking at a lot of data, when is the best time for a certain thing, signals, all that. But when you're about to trade and you like for example, we have a stock search for calendar. So we're looking, in a prior, we covered this right in a prior, we've done so many of these in a prior podcast. So
Yeah.
And then so now these are the ETFs that we think are good for calendars. So we already have an axe to grind, so to speak. And now the kind of the final analysis is you want to see some good edges in your favor. And so I'll go through these and how we calculate these on a level. So I think the easiest one to understand is so we'll click on this trade. So this is a trade that we've scanned for. We've scanned for certain ETFs. We have a double calendar. So we're expecting and I could explain it a little bit better with the payout picture, but 20 days to 10 days, we're buying 20 days, selling 10 days. So we've kind of found high implied volatilities for 10 days and lower ones for 20 days. So, and then we're using a distribution edge. We're using a forecast edge. You'll notice that I don't put much value as you drag it over to the right. That would weight that very heavily. You could see kind of behind the scenes things are moving, but I just do a little bit on the S, because if you get too much, and then I know I'm getting ahead of myself, but this is a smoothing edge. So that's about where market makers should price the options. And a lot of times when you get wide markets, you'll get high S, either positive or negative, and you're rarely going to get filled at that area. Market makers know what's going on. So you want to find something kind of near the market, slightly with a little bit of edge. So let's take a look at this top trade that we've rated based on our ratings, which include theoretical values. So again, the payout picture at expiration are 2/10. While there's a call calendar. If you just put in a call calendar, it's just going to look like this 1/10, and you want it to go up and expire around there. If it's a put calendar, you want it to come down to right about your short. And then that's when the calendar is worth the most. If you put on two of them, you have some room in between, and a pretty wide area of green here that you can make some money. So then what you'll notice is, like I said, we've searched on these, and we've seen a fair amount of distribution edge. So a distribution is what we show here. It's this kind of normal but not normal distribution. We go and calculate that by going back and actually observing movements in the ETF, and we put those in a bucket. So we're valuing these at the expiration of the front month. So that's 10 days. So we'd go out 10 days and we observe all of the movements in the stock, and we put those in these various buckets. And so then that you develop your own distribution. So that's an interesting one. So right now, given this distribution, it's only trading for 50 cents. So there's a lot of edge in this, in the distribution here. So the second theoretical value that we have is a forecast edge. Now, a forecast edge, we try to forecast the next 20 days of volatility, which is obviously very difficult, but we've been doing it for a long time. Our R squared is somewhere in the high 20s for these forecasts, so not very high if you understand regression analysis. It's between 0 and 100. People say 100%. So ours that's pretty low to have only 20, but it's actually turned out to be somewhat useful based on our back test. And so regression implies you have independent variables. Of course, we're using things like historical volatility. We're using things like change in implied. So we have a number of different variables that go into our forecast. And so we come up with a forecast. And when you use that formula that comes out of a regression, now that's valuing it at 78 cents. Again, it's 51 mid, and that's, it gives you 18% of edge. And then finally, our third edge is called our smooth edge. And our smooth edge for this particular one is kind of right on the number, which is basically what you want. I mean, what that says is, when you're smoothing, you're drawing a smooth curve through the implied volatilities, and you want to see you want to make sure that you're not overpaying. If you're underpaying too much, the market makers probably won't give you a fill. So you want something kind of in the range there, and that's how I use a smooth edge. I'll almost always look at a smooth edge when I'm trading, so I know, we're probably going to have to give the market makers 2 or 3 cents off of the mid market and the smooth edge. So maybe 54, we would expect a fill on that one. So Tyler, I'm going to go ahead and just trade this particular calendar.
Okay.
We'll force it as filled, and so that'll be our trade for this week. And then we'll go and check out a little bit more of what we're talking about with the edges that we're looking at. So I wanted to get that sent off. So let's talk about these edges for a moment. And one of the things I like to do as well is check out the trade history. So the trade history will show you, where this particular trade has been, and I think that's another good thing to look at for this particular trade. So it takes a minute because we're going to go get every minute. So this is where we are right now, 51 cents. So I'll just kind of drag it down. So this is a graph of stock price and implied volatility for the particular strikes. And you can see that this one was worth about 53 cents a bit ago, and now worth about 51 cents. The green there is our SMV value. So, as it's kind of jumping around, as markets tend to do, you'll get edge, and you'll get, so it's doing what it's designed to do, smooth things out. So, again, this looks like a reasonable trade to do based on where it's been and the edges that we have there. Tyler, did I miss anything, or do you have any comments on that?
No, that's a great dive into the theoretical values. I just wanted to sort of summarize each of them and sort of explain just overall, like what each of them is good for, like what we look at them for. So we look at the S%, which is the sort of percent edge that our theoretical value is over or under the market price, right? And so that's how we calculate that percent edge.
Right.
So
let me just stop you there for a second, because if you don't mind. So what Tyler's talking about is, so we have a bid ask. So this particular, so here's IWM. This is our options chain. And one of the cool things that we do is we show you where we're buying these strikes and selling these strikes. And so you could see the month. So we're selling March 27, buying April 1st. So and then we could look at where the markets are, and we could look at what the SMV values are in our chain. So that's really, really useful tool here. So and you can see that this is what you want. You want the smooth values to be right around. And I mean, this is one of the hardest things that I've done as a technology owner, software provider, and market maker, is to come up with these formulas. I mean, we're using in order to draw these orange lines and create these theoretical values, a lot goes into it. I mean, our smoothing is very intricate, and to draw that line, it's actually, we've utilized, people use cubic splines, but they don't work too well on the outside and the tail. So we've actually utilized some graphic video game code in order to figure this out the best. It's pretty crazy, but that's how we've done it. And what you want to see is these theoretical values, hopefully pretty near, or if it's off, it might, it would be an opportunity. Sometimes it gets off if there's an order or whatever. But anyway, Tyler, I interrupted you, but I wanted to point that out where the S% comes from.
Oh, that's great. Yeah, we're just looking at the S percentage. We're trying to get that sort of inside a range, right? And we're really just using it for, like you said, making sure the market's not too wide, and we're just trying to find something sort of within a range. So oftentimes in the option scanner, you'll set a min and max value of negative 0.3 or negative 1.
Like you'll go, so it's in percentage terms. So if you go -1 to 1 or -2 or -3, just depending on what, for ETFs, usually, 1% is probably enough. 2% usually, you don't see a lot. Like there's a gold trade that's 2%. There was an SPY at 1 that's, also there. But yeah, you want those in a range, because if it's too off, you're just not going to trade in it. And all your other theoretical values that you're sorting on are most likely off as well. So you just want to filter those out, is what I've found.
Right. Yeah. So I think that's great for the smoothed percentage, that S%. So next I want to talk about distribution edge, which is that D%. And that, in simple terms, it focuses on the distribution of past stock returns over the same period of time as the trade's days to expiration. And so what we're basically doing there is using, 15 years of historical data to calculate the likelihood of the stock price ending up at certain points. And that's sort of why we draw that sort of light gray distribution in the background of the payoff diagram. And so this is just used for, like I said, calculating the likelihood that the stock price is going to end up there. And so it's good for valuing the trade price based on expected stock movement. So that we're not looking at volatility or earnings or anything like that. We're just looking at where it's historically ended up for that expected time frame, days to expiration.
Yeah, exactly. And so we'll just do an expected value. Basically, you're multiplying the percent chance of something happening by the profit at that point, and then you just add those all up, and it's 100% chance, because that's the distribution's equals 100, and then you just divide by 1 essentially and get your expected return. So that's how the distribution edge works. It just counts what you're making times each. These gray bars represent a percentage, and that's how you get that amount. And then as a side note, we use the distribution edge in order to get the probability of profit. The probability of profit is just where it's green. So there's 82% probability of profit is the green portion. If you add up all the bars in the green portion, you get to about 81.7%.
Right. That's a great explanation. So then if you want to, go further than just, expected stock returns, and you want to look at volatility, that's where the forecast or F% edge comes in. And so we calculate a forecasted volatility surface. And you read my mind, Matt. I was just about to suggest pulling up the trade builder so we can see that. That colorful gradient there on the right is the forecasted volatility surface, where we overvalue or undervalue how much the volatility is worth based on our calculations.
Right. It's a little bit simpler for ETFs, but for stocks, we're actually if there's an earnings, we're forecasting what that earnings is going to be. So we go ahead and we do a forecast for the entire surface, based on how we summarize and turn into constant maturities a lot of the information from the option prices. So we'll go out and we'll say, okay, what is the implied volatility at the 30-day, and what is the implied volatility at the 2-year, and then so that gives us, a term structure that we could draw. And then, like I said, if it's a stock, then we'll put earnings dates in there, and then we'll also forecast the earnings moves in there. And then there's also we calculate slope. So are the puts versus the calls expensive or cheap? And there's ways that we go about valuing those from a percentile, and also if there's some regression analysis, independent variables that help project what the slope should be, or we think how the slope is moving. So it's not only a term structure, but it's a strike by strike skew structure that we're forecasting, and that helps us get our, then you make a forecast for the entire skew term structure and strike by strike, and then that gives you a forecast of volatility at each strike, and then you calculate your theoretical value based on that.
Right. Yeah. Thank you for that explanation. So that's essentially our 3 theoretical values that we use in the option scanner. So you can combine them to sort of rank the trades and set min and max filters like we did on the smoothed edge to sort of find the best trade based on what you think is important in valuing the price and determining what's overvalued or undervalued.
Right. You could, and that's what I'm doing when I'm dragging these. Like I like in this particular one, I like a forecast. I weight that a little bit higher, and the smooth isn't valued that high, but there's a little bit there. You can see a little orange, and then we reward risk and probability of profit. I also throw in there.
What strategies would you so you're valuing this forecast edge higher because it's a calendar trade, but is there specific strategies that you would weigh the distribution edge higher?
Yeah, so it just, and it depends on the stocks too. Some stocks are vastly different than they were, maybe 5 or 10 years ago. And so if they're that different, the distribution edge isn't as valuable, because to make the distribution edge, we use a lot of history. So it's kind of, the D is the most history, F is the second most, but we use a fair amount of current, and we weight the current information more. And the S is just right now. So it goes in that continuum. The D has a lot of history. The F doesn't have that much history. And then the S has very little history. So it depends on, if it were a longer term trade, I might look at D a little bit more. But this is what I would consider a shorter term trade. So I like to look at F and a little bit of S. Does that make sense, Tyler?
It does. We've also gotten some questions in the past about how we take earnings into consideration when calculating these edges.
Right. So the distribution edge does not use earnings, other than, it counts all days. So that's, again, it's a longer term measure. So if you're looking for an earnings trade, I would not use D. The D is a longer term that usually would encompass at least one, so 90 days or more. The forecast does very much bring into account the earnings. So we do a forecast of the earnings moves, and we bring a lot into that. So if I was doing an earnings trade, I'd look at the forecast a lot more. And smooth, again, is always going to be, between a certain min and max. So that's how I think about those, Tyler.
Yeah, I think that's very important to consider. Which theoretical values are good in which circumstances, right? We use S% to narrow down the wider markets or mispriced markets, and then we use the F% when making an earnings trade, and then distribution percent when you're just sort of looking for a longer term stock-based trade that doesn't really have earnings in consideration.
Right. Yeah, so I think that's a good overview of our percentages, and also how you would use them, and in what types of situations you should weight them higher. Again, the weightings are, here, and you could save these scans. So you just kind of, you go through and you find your stocks, you save that, you go through and you find a good strategy. And then when you save this, it saves all of your inputs, including the min-max of the column headers and your ranking. So you could just come back to this. And if you want to have on these calendars at certain times, it's helpful to come back and use this template in order to find the best trades that you have based on not only are they good candidates given the ETF itself and how it fits in with larger volatility numbers, but then specifically how the trade rates based on again, D percentages, F percentages, and S percentages, as we call them, smoothing. We saw that in the strike by strike. F, the forecast, we saw how implied volatility and historical volatility changed that forecast value. And then the D, how much the stock has moved, and we put those into buckets for in this case every 10 days we would observe where the stock move and make our distribution based on that movement in the stock over that period of time. And that's how we determine these values. And it just puts more things in your favor as you're trading to find not only the right ETFs to trade, but the right options to trade. In this case, there's probably thousands of different combinations, but given our weightings, we narrow them down to a certain few, Tyler.
Yeah, it's very, very efficient. The option scanner, it's very easy to use, and you can very quickly find the best trade.
Yep.
So I also wanted to add, we have all this information up on ORATS University as well. So we've written down how we calculate these theoretical edges. You can also go to on the resources. There you go. We write down how we calculate the theoretical edges. It's in the option scanning in the 400s right there. Yeah, so we go over all the stuff we just talked about. In this video, we summarize it on ORATS University, and we also sort of dive into the calculation, the technical part of it a little bit more.
Yeah, there's a lot of resources out there. I know it gets a little bit complicated, but these are things that once you start using and once you get your templates, and we're going to start putting in more templates out there. You understand what you're looking for, and these are a really good way to find. I wish I had these when we were making markets, but we tried. I was one of the first ones hardwired on the SIBO floor, and we would have that's when we started doing our forecasts, calculating historical volatility and trying to figure out what each option was worth, and it would light up. So it's kind of interesting. But anyway, this is where it's come to, and it's many orders of magnitude. It's complex, but it's also hopefully understandable and well integrated, so you could utilize it, even though it does use a lot of data. There's a lot behind it.
Yeah, definitely. All right. Well, I think that covers it for this week. Thank you, Tradier, again for hosting us. If you guys have any questions, you can leave a comment below. We read through all the comments, or you can email us at support@orats.com. And we'll see you guys again next week. Thank you, Matt.
Thanks, Tyler.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy. and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.